Okay, here we go. It is Monday, December 16th, and we are back with Snezana Todorova to go over all of those important mortgage changes that have taken place as of yesterday. So this is fresh, hot off the
Good
press.
morning. Yes, and it's actually going to be a busy day for
Oh,
mortgage
it
brokers because
is.
actually, yes, the actual rule came into effect yesterday. But since it's Sunday, basically, lenders and mortgage insurers are accepting new applications based on the new rules as of today. So,
Yeah, that's right. And that's what I
there-
remember. Like we did this last time.
yes.
And it was proposed at that time, right? It was
Mhm.
these changes could come into effect. But here we are, a month and a half later, and they're in effect. So, Susanna, like even in conversation with you last week about something different, there is many nuances to these changes. It's confusing for you, then it's confusing for
Sometimes,
us.
exactly, it's even confusing to me, and it took me maybe, I would say, a good 2 weeks to
Yeah.
go through and actually being able to explain to our clients in simple terms what those changes are.
Yeah, so if you wouldn't mind, I would love if you could break some of that down, how it affects first-time home buyers, and then of course even the pre-construction, in terms of amortization there. So I will let you take this away, please. Like,
Perfect.
what are some of the marked changes that you think you can really see this making a difference for someone's affordability?
Absolutely. So this, yes, I would say the most important change would be the ability to increase the amortization from 25 years to 30 years for first-time home buyers. And that mainly, when we speak about amortization, probably many of us know, but I will explain that again. Just mention that the amortization is the number of years it takes you to pay off the mortgage in full. So of course, for somebody who takes 25-year amortization, that means that they're on track to pay the mortgage down over 25 years. However, they have to come up with a slightly higher monthly payment per month in order to do that. And up until last week, for somebody to be able to get a 30 amortization, they needed to make 20% down payment.
Mm.
So here the first change is first time home buyers, they are able to make less than 20% down payment. So as little as 5%, depending on the purchase price. And they are able to stretch the mortgage over 30 years, which will result in lower monthly payments. And of course, knowing how expensive everything is, even though inflation is down, having that cash flow per month, I feel like it's key for many first-time home buyers to be able to finally afford the monthly mortgage payments.
Oh, absolutely. It's
Mhm,
that
mhm.
we keep coming back to this in our conversations. It's managing that monthly budget and that monthly
Yes,
payment. And
yes.
I know short term, usually the resistance to something going from 25 years to 30 years is, well, I'm just going to pay more, right? In terms of insurance, in terms of my
Mhm.
final payout is going to be so much more. I'm sure you hear that quite a bit as well.
Absolutely, but as you mentioned, for us, we definitely go through the monthly budget and making sure that
Yeah.
that those numbers make sense
Yeah.
and with
You
the
have to
lower.
prioritize home ownership.
Absolutely.
I feel like at a core, I think home ownership, if that's a priority to you, then this is a creative option,
Exactly.
right?
Absolutely. And of course, that doesn't mean necessarily that you will take 30 years to pay off the mortgage.
Right.
As your income grows, maybe you get some, extra income or part-time income. You never know. Maybe you play the lottery. We don't know. But you will be able to make lump sum payments as well. Or even maybe, 5 years from now, when your mortgage is up for renewal, maybe you can afford $100 or $200 more per month, right?
Exactly.
And
Yeah.
everything that you make on top of the minimum payment goes directly towards the principal owing, and you're reducing the amortization.
Hey, because you just brought it up,
Mhm.
right? Because if we are actually going to like speak to first-time home buyers here a little bit, because these changes do affect them, can you break down what that means, just so people understand? The portion of the payment that goes to principal and portion of the payment that goes to insurance, because you just said anything above and beyond your monthly minimum monthly goes entirely to principal. So how does that affect their overall total owing then?
So basically, yes. So for somebody who is making some prepayments or lump sum payments here and there, that extra payment always goes towards the principal owing. And then because the actual monthly payment doesn't really change after you make a lump sum payment, or let's say you put $500 here, maybe $200 there. Your monthly payment will not change. However, what is changing is how much of that payment goes towards principal, because as the principal goes down,
Right.
the interest on that principal also is being reduced.
Right. So the
So
monthly
you're
payment is
able.
broken into those
Exactly.
two
And of course,
buckets.
yes, once we get to that point where with clients we're looking through options, I always show them the amortization schedule as well. And they can actually see with each payment how much is going towards principal and how much is going towards interest. Of course, at the beginning, more of the payment goes towards interest.
Interest.
But as you go, year 5, 6, 7, 8, 9, 10, this is where you see more of the payment goes towards the principal going.
That is a fun. That's both exciting and jarring to see just how much you
Yes,
pay in
it's at
interest.
first glance,
I
but
know.
uh,
Oh,
again, at the end of the day, as you mentioned, Varsha, what is your end goal? Is it
right.
is it more important for you to own a home? And of course, this is something that down the road you eventually build equity as well. And of course, equity is something that, as we know, it has helped a lot of people also invest in more real estate. Or down the road, you can use that as your retirement plan as
For
well.
anything,
Mhm.
equity, holding it, it really does open up doors. I think it makes a lot of folks breathe easy, especially even in today's economic climate here. It has definitely helped people to tap into their, say, their HELOC or refi. Like, it just has assisted them even just to go visit loved ones if they needed to because their disposable income couldn't cover it, right? Like I think it has, I think there's a
And
lot of
also
value.
for us as parents too, like it's at the end of the
Yeah,
day, our home will be here for our kids. Would they? It of
exactly.
course it depends if they want to sell, keep it.
I know.
They will decide eventually. But again, it's something that they will be tremendously grateful for to be able to.
Absolutely. And I love that we're having these conversations with our children. I love that. Now, can you touch on, Snezana, that the interest in that price cap from a million to 1.5, and really in that purchasing bucket, do you see it making a big difference?
Yes,
Okay.
absolutely. And so the change where up until, yeah, again, last week, anybody, no matter if they're first time home buyer, repeat buyer, anybody who is making a purchase and the purchase price is $1 million or over, the down payment used to be 20%, but this has changed. So right now, borrowers, again, first time home buyers as well as repeat buyers, they can go up to 1.5 million purchase. So right below 1.5. So it has to be 1.499999 purchase price, and they can make less than 20% down payment, and the calculation is 5% on the first 500,000 and 10% on the remainder. So
Okay.
in general, the down payment could be as little as 125,000
Yeah. And I'm sure there's specific
compared
criteria.
to 300,000 on
Right.
1.5 purchase. Where I feel this would make the most change for many home buyers would be in that price point. Probably you can agree with me, like a little bit over, like 1.1,
Yes.
1.2. Uh, this is where the drastic change comes in, because again, this change would be beneficial for borrowers, probably two income earner, like two
Mm-hmm.
income earners that have high confirmable high income. They just didn't have enough time to accumulate 20% down payment, especially if they have kids. Again,
Oh,
it's difficult to budget and save 20% down payment in order to get to that a little bit over a million price point.
and that truly is sort of the deterrent, the down payment threshold to get in, especially in a community that is thriving, that has access to transit, that has amenities, highways, right? Like the
Mhm.
$1 million price point right across the board for so many of the communities along the 401 corridor, even for us, because we're west,
Yes.
it's $1 million to get into something decent,
And
right?
that's
And
again $200,000 compared to
yeah,
much lower.
yeah,
It would be,
absolutely. I
so
think
much
that's where
easier.
I would see the most change and the
Yes.
flexibility, in terms of stretching their dollar a little bit more and making it a bit more affordable is changing it from 25 years to 30 years, as well as changing, say they have to buy a home and it's just under 1.1. I think that 1.1 to 1.3 Like that's where a lot of those
Yes.
detached properties sit, and people value detached properties,
Mhm.
Nizana. You know,
Mhm.
they
Absolutely.
appreciate quite differently than something that's a semi or a town, right? And we have such an
Mhm.
influx of condos, and they're waiting for buyers, right? So I think I'm excited to see how this affects overall buyer confidence. I think
I
buyer
definitely,
confidence.
I probably, well, you will be able to share with us too, but I would assume that we might even see some bidding wars coming back in
Oh
certain
yeah,
pockets
yeah.
for well-priced
Yeah, I've
properties.
definitely seen aggressive pricing come back into
Mhm.
the market. I mean, it's always been in neighboring markets. So for us, we're in Guelph, but neighboring markets more west, you know, Kitchener, Waterloo, they tend to do aggressive pricing quite a bit. I've seen it in pockets here in Guelph as well, right, where you list low, but it's all a strategic play because you want to get the seller the best price possible. Right. So, anyway, that's a different conversation altogether. Let's get back to this focus. So, those two are big mortgage changes that have come into effect as of yesterday. Now, when you say first time home buyer, I just want to break this down just
Yes.
a little bit. Could you break down who qualifies as a first time home buyer here?
Yes, absolutely. That's this. I feel like it's the most confusing topic
Mm-hmm.
from all. So there are several programs where the definition of first-time home buyer it's actually different from program to program. So just I wanted to put it out there. As we know, we have in Ontario the land transfer tax rebate. If you were to purchase in the city of Toronto, there would be municipal land transfer tax rebate as well. So the definition for somebody to be able to apply for the land transfer tax rebate is that they've never owned a home, so they've never been on a title of the home generally like anywhere in the world. So, and you cannot really requalify as first-time home buyer for the purposes of the land transfer tax rebate.
Right.
And this is kind of the more strict definition. So land transfer tax rebate, it has different definition than who is considered first-time home buyer regarding the new changes that came in,
Right.
including the 30 amortization. And so basically and also the ability to withdraw funds from the RRSP as well.
Mm-hmm.
The
Yep.
definition of who is considered first-time home buyer is the same as the definition for the 30 amortization extension. And the definition is it's again it's a little not confusing, but again people viewers can always reach out to us to clarify.
Of
But
course.
somebody exactly first time home buyer is somebody of course that have never owned a home before,
Mm-hmm.
or maybe they've owned a home in the past but they have sold it and they've rented for the last, to be safe side I would say the last 5 years,
Okay,
to be on
because
the
that
safe
was
side.
going to be my next question because we sort of we get this thing that comes up where people have say they've been on title and for whatever
Mhm.
reason it's been sold, they've,
Exactly.
you know,
E-
split up and then
Exactly.
they've
Now,
rented.
let's say I'll give you an example. Let's say a borrower was on their parents' cottage
Mm-hmm.
title. The cottage is a vacation home. So basically, this is not her. Even though she is on title, that's not her primary residence. She
Okay.
was renting, so she is considered first time home. Even though she's still on title of the cottage, she is
Right.
still considered first time home buyer for the purposes of going with the 30 amortization and also withdrawing funds from her RRSP if she needs to.
That's
Um,
fabulous. See, that is
exactly.
like such a nuance that at first glance, a first-time home
Mhm.
buyer, people would not think that.
Exactly. As somebody who has recently gone through separation or divorce,
Mm-hmm.
again, they would be considered first-time home buyer to get the 30 amortization and also withdraw funds. Actually, somebody can, as a first-time home buyer, they can withdraw up to 60,000 from their RRSP. So let's say if we have two borrowers on the application and they, of course, were able to contribute and have accumulated a good amount of funds in their RRSP, they can withdraw up to 60,000.
Right.
And not only that, but somebody who has, let's say, an investor who owns maybe one or two investment or rental properties, and they never occupy those properties as their principal residence, and that investor rents somewhere
Mm-hmm.
currently, they can still be considered first-time home buyer for the purposes of purchasing their owner-occupied home.
Fabulous.
So a lot of little
Yeah, nuances,
decisions
right?
and
You have to have
exactly.
a private conversation for this
Mhm.
because I love that there's flexibility.
Yes, yes.
Right, absolutely. Now, I know that the first home savings account, is that something we want to touch on right now quickly, or should
Yeah,
we save that?
absolutely. So
Okay,
first home savings account, again, definition is pretty much the same. As long as you haven't owned and lived, I just wanted to say also, let's say if there are two borrowers on the application and one spouse has owned the home before, as long as both of them have not occupied that home together in the last 4 years, they still be considered first-time home buyers. So again,
great.
a lot of nuances, as you said.
Yeah, 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 no,
First home savings account, it's very imperative. Even if you're not planning on buying a home this year or in the next 5 years, make sure you open the account by the end of the year. So by December 31st. Reason being is because you can carry over the contribution room to the next year. So even if you open the account, make a $2
mm-hmm,
contribution,
mm-hmm.
that's still you will be so happy that you did this year because next year you can contribute, let's say 16,000. So in general, it's 8,000 per year,
Okay,
up
all
to
right.
40,000.
And you have to make that application to carry it. Oh, like you have to open it to carry, but once you open
Exactly,
it,
exactly. So let's say somebody opens the account today, well, let's say December 31st. So they
right?
will be able to next year they will have 16,000 contribution room versus somebody who opens the account January 2nd, they will only have 8,000.
Yeah, fabulous.
Yes,
Oh, this is
and that
great.
exactly. Contributions are tax deductible, same as RRSP. So
Yeah,
you can claim that on your
yeah.
tax returns.
And that's what I was going to say. That is the benefit of a first home
Yes,
savings account.
yes,
Please use whatever you can for the tax
exactly.
deductible bit, right? What else? Now, I know that renewals have changed, but that changed in November in terms of the stress
Mhm.
test, right? Is that something we can touch on briefly?
Yes, absolutely. So for borrowers who have uninsured mortgages, they are able to renew their mortgage and switch the mortgage to a new lender without having to go through the stress test. And just to remind, as a refresher, the stress test is, again, we're stressing about it most of the time, but
Yeah.
it is a rate where we have to use that rate when qualifying the mortgage application, just to make sure that the borrower is able to qualify at a higher rate if rates were to go higher at renewal time. So let's say a borrower is purchasing a home at 4% right now, the stress test would be the contract rate plus 2, so 4 plus 2.
Hmm.
So we have to qualify actually at 6%, and making sure that the income is high enough as if the borrower is paying 6% on the
Yeah.
mortgage.
Have you experienced this since the change, Snezana? I'm only asking, like, do you see lenders becoming a little more cutthroat to keep their clients because the stress test is gone?
Yes, I would say that more and more lenders they've always been a little more
Yeah.
aggressive because again at the end of the day it's so much easier for them to keep their existing clients rather
Yeah.
than attract new ones, and they've been quite aggressive. But at the end of the day, with renewal time, it's also a great opportunity for the borrowers to review their overall budget, any other liabilities they might have, or any future potential renovations, or maybe other
Yeah.
tuition costs, something that it's coming up,
Of course.
and we can plan ahead and make sure again it comes down to the monthly cash flow for them.
Cash flow. Oh,
Mhm.
absolutely. And you're right. And most people, as much as the lenders don't want to capture, and attract new people and would like to retain their own, most borrowers also don't really want to go shop around to a whole bunch of people. Like that's not really what they want to do. Submit documents again and do all of that, right? They want it
Exactly.
at the best rate possible.
Yeah. Mhm. In some
Oh,
situations, it makes total sense for the borrower to stay where they are.
yeah.
In others, it makes sense to make a switch and maybe
Yeah.
consolidate and get a better advice somewhere else.
I heard this comment, a couple weeks ago, and it was, yeah, and switching kind of saved them $1,000, and it wasn't that big. But you know what? In these kind of inflationary like times when everything feels really stretched for most people, everything makes a difference for them, right? Like I find in conversation with clients when we're actively showing properties and stuff, it's the conversation's different. Like the mindset is different. These economic like gloom and gloom stories play a big part. So saving $1,000 stretched over a year can make a big difference to a borrower's monthly budget.
Totally.
Now, the big Bank of Canada rate announcement happened as well
Yes.
last week, and we'll wrap it up with this. But this, of course, affects our variable rate. Can you touch on that? Maybe also like how it changes HELOC payments or other, credit card payments and things of the nature.
Yeah. So Well, credit card payments, unfortunately,
Oh, not
they're
not
not
credit.
changing. Yes,
Right.
unfortunately, I mean, I would say, speaking to the credit card payments, anywhere, like when you think about it, it's like paying 20%, it's quite
Mm-hmm.
high. But
Right. Or
another, that's maybe another,
consolidating, I suppose.
exactly, but that's another
Yeah.
conversation topic. There, yes, Bank of Canada reduced their overnight rate, which in turn influences bank's prime rate, and variable rate mortgages, student lines of credit, also student loans, and unsecured and secure lines of credit are all based on the prime rate.
Mm-hmm.
And we saw the prime rate drop by 50 basis points, which again, they refer to it as a jumbo cut, which yes, it is. And but just a little background story from 2022 and 2023, when Bank of Canada increased the overnight rate by almost 5% for a period of 18 months.
Yeah.
That was quite a lot. So this is why we see now the big cuts coming in. And yeah, right now, prime rate, it's at 5.45. What it means, for example, let's say if somebody is in a variable rate mortgage at prime minus one, and prime is 5.45. So right now their rate would be 4.45.
Mm-hmm.
And yes, there is a quite a bit of reduction depending on the mortgage amount, but in general, we can expect, let's say, $18 to $20 less in payment per $100,000 mortgage. So let's
Okay.
say if you have a $500,000 mortgage, that cut may give you a little bit of a little bit over $100 in a lower monthly payment, which again, it's as you mentioned, everything counts. Now,
Everything
fixed
counts in this
rates,
sort of
yeah.
market.
As you already mentioned, fixed rates are not impacted by the Bank of Canada rate cuts. So fixed rates are still, they're already lower than variable rates, and they've
Mm-hmm.
already came down a bit, quite a bit from last year. But
Yeah.
in reality, we will see around four to like low to mid 4%.
Is that the alarm of us needing to wrap up here?
Give me just a second. Let me just stop. There you go.
Okay. And I think with that, we should wrap this up.
Yeah.
Right? Well, I feel like I've taken up so much of your time, but I think these are crucial conversations we're having on the daily. Snezana, is there anything that we didn't touch on that really impacts from yesterday's change?
Not really. I feel like again, just for anybody out there, if they're not sure if they qualify as first-time home buyer, reach out. We'll be able to kind of send you a lot of information to read through and make sure that to help you understand if you're a first-time home buyer or not. And yeah, open that first home savings account.
Open the first home savings, and I will make sure to add Snezana's, in terms of links to get to your website or
Yes,
your Instagram handle. Please get in touch because do the due diligence. This is how you move the needle ahead, right? So
absolutely.
thank you, Snezana, again for your
Thank you for having me.
time.
Thank you. Have a great day.
You too.